The biggest expat tax mistake that many U.S. taxpayers living abroad make is starting with the same assumption. I live outside the U.S., so I don't have to file U.S. taxes. Listen, that assumption is flat out wrong. The United States taxes its citizens and residents on worldwide income, no matter where they live. And when expats miss filings, the problem rarely remains simple. It compounds across multiple tax years, and unreported offshore income coupled with unfiled foreign information reporting forms expose the expat to draconian penalties at best and criminal tax and foreign information reporting fraud at worst. Well, first of all, expat compliance is not just about filing a 1040. It often includes foreign income reporting, foreign bank account reporting, and multiple international information returns. Once a tax return or an offshore information filing is missed, the IRS can compare your lack of submissions against third-party financial data obtained from offshore banks, brokers, and financial institutions that are required to be given to the government under FACTA. If discrepancies appear, the issues can escalate quickly. What starts as a simple filing problem can turn into a broader offshore enforcement issue, and in certain cases, even a criminal tax or foreign information reporting fraud investigation. So what are the deadlines most expats misunderstand here? Well, first of all, expats do not receive additional time to file. Most qualify for an automatic extension from April 15th to June 15th, but here's the catch. Interest still accrues from April 15th on any unpaid tax. You can even request further extensions of time using Form 4868, but extensions only delay filing. They do not eliminate penalties and interest. You must pay what you owe by April 15th. And separate deadlines and penalties apply to foreign bank account reporting, FBAR, and other required foreign information reporting. The most dangerous foreign information reporting we see people screwing up is the FBAR on FinCEN Form 114. It is often the most critical filing that expats routinely overlook. It applies whenever the total aggregate value of your foreign financial accounts exceeds $10,000 US at any point in the calendar tax year. It is not filed with your tax return. It is filed separately. It's filed through FinCEN's online system, and it carries its own penalty structure. In serious cases, willful FBAR violations can trigger criminal prosecution on their own. There's also other forms that can create high-risk exposure beyond the FBAR. For example, expats may be required to file Form 8938 for foreign financial assets with their personal returns, Form 5471 or 8865 if you own an interest in an offshore business, Form 3520 for foreign trusts or gifts. Each of these forms has its own penalty regime. For example, failure to file an 8938 can trigger a $10,000 penalty, with additional penalties if the noncompliance continues. And here's the critical point. These penalties can apply even if no additional U.S. tax is owed. If you did not report foreign taxable income, and you also miss foreign information return filings, the question to start off with is somewhat simple. Was the failure willful or non-willful? If it was non-willful, you may qualify for the streamlined filing procedures. These procedures allow taxpayers to correct past filings with reduced or even no penalties, but they come with a risk. The IRS can come in and audit a streamlined submission. And if during that audit, the IRS determines your conduct in reality was willful, the consequences could escalate criminally and quickly. If your filing situation involves large foreign account balances, repeated multiple-year patterns of noncompliance, significant amounts of unreported foreign taxable income, or inconsistent filing of records, and you find yourself under audit, you're dealing with an eggshell or reverse eggshell audit scenario. In those cases, filing late returns without a strategy can invariably create evidence of criminal intent that the government can later use against you. This is where many taxpayers and their lesser representatives make critical mistakes. Two mistakes that we regularly see creating serious criminal tax and foreign information reporting fraud exposure are as follows. First, making a quiet disclosure. That's where you file a late or amended returns without a structured legal approach, and usually without doing the foreign information reporting. Second, backfiling records, creating or altering documents to match what you believe the IRS expects to see. Both of these actions can transform what should be a civil issue into a criminal tax and foreign information reporting fraud case. If you live abroad and you've missed U.S. tax filings or information returns, you need a comprehensive strategy in place before you act. Listen, expat compliance is not just about filing missing income tax returns. It's about choosing the correct pathway to return to compliance while properly documenting your position and managing any criminal tax and foreign information reporting fraud risk before the IRS comes in and defines the narrative for you. At the tax law offices of David W. Klasing, our dual licensed tax attorneys and CPAs expertly handle expat compliance as both a civil and potential criminal exposure issue. We're going to help you regain compliance while protecting your net worth and your very liberty. Call 1-800-681-1295 or visit klasing-associates.com to schedule a confidential, reduced rate initial consultation today. You won't regret it.